and wires business. What the street doesn't like, capital allocation worries, as well as Grasim. It could have been done under Grasim. How do the numbers stack up? 1,800 crores you're putting in. Revenue potential could be around 7,000 crores. Margins could be in early teens. For UltraTech, it's very small. They generate 10,000 crores of cash flows. This will be less than 10% of their annual capex plans as well. Jeffrey says if there's a knee-jerk reaction, which we are seeing, it'll provide a buying opportunity. So that's the big story today. UltraTech moving into the cables and wires space. Not too good for them, but even worse for the cables and wires players that are seeing sharp downtick.
All right, we've got the first rates coming up on your screen, right in queue. What do we have? It's kind of mixed, but blinking literally on the Nifty Bank, at least red and green. There you go. I think settling down now. 0.2 higher on the Nifty, so let's go with that one first. 0.4 on the Nifty Bank, so it's up. It's up in a decent way, at least to begin the day. IT index is flat on your screens. You got some 2:1 in terms of advances to decline ratio. More up than down. The Nifty heat map is coming up into view as well. Let's just have the Nifty Bank as well. Yeah, there you go. Half of 0.45 on the Nifty Bank at this stage, and it's opening up as we speak. Lots of banking and financial names at the bottom of the screen, and of course we'll look at how names like UltraTech and that cable and wire segment is opening up as well. But I mean, at the index level, it's a good start, guys.
Well, banks outperforming. The Nifty Bank is up nearly 200 points, 0.5% gain at opening. The top gainers include Shriram Finance, Bajaj Finance, IndusInd Bank, where 9.5% of its loans go into the MFI sector. IndusInd Bank has seen some buying. That's up 1.5%. And big boy, HDFC Bank too, is holding up in the green with a gain of more than 0.5%. So banks on the front foot today. Other than that, Wipro stands out in the tech pack. It got very close, or it maybe even breached the 200-day moving average in Tuesday's trade. But Wipro has bounced back from that critical support, and that's up nearly 1%. Reliance Industries is stronger today, so that's holding up and helping the Nifty and the Sensex keep itself up in the green. Hindalco on the back of the upgrade is up 1.2%. JSW Steel also up nearly 1%. Tata Steel up in the green. Metals had a rough session on Monday and Tuesday, and there is some rebound that you can see. On the way down, UltraTech Cement, it's a big 3.5% fall on UltraTech Cement. Top Nifty loser, two-wheelers in the red, 1% lower for Hero MotoCorp and Bajaj Auto. And other stocks down in the red include Trend, SBI Life and BPCL. All in all, it's a mildly positive green tick on the Nifty and the Sensex. So benchmark indices holding up in the green. It helps that the RBI has turned accommodative, so that's pushing up the banks. Crude prices too have eased to about $72.50 per barrel, but the mid-cap index is absolutely flat in the red right now.
Well, that's right, Rima. You know, UltraTech Cement, that's a little bit lower because of capital allocation woes. The street would have liked them actually to focus on their core cement business, so that's down close to 4%. But take a look at the nervousness in the cables and wires business. Polycab, 10% down. Massive volumes out there for the first minute of trade. KEI, down 10%. Massive volumes out there. Havells down close to around 9%. RR Cable down close to around 8%. Those stocks are taking it on the chin as we speak. Big downtick is what we're seeing out there. A few more stocks are a little bit lower on high volumes. You have Inox Wind. That stock is lower. RVNL, well, that one as well has, both of them have opened up a little bit lower. Inox Wind, in fact, is actually opened up. So good up move is what we're seeing on that one. RVNL is down close to around 2%. What else is moving around? Credit Access Grameen, I think there was a good green start out there. AB Capital as well. Big green start is what we saw, so a good uptake on that one. And Transformers and Rectifiers, they're guiding for better times ahead. Well, that stock as well is, up and about in today's trading session. So the headline index still holding in the green. The level you need to look at on the upside is 22,650. And the Nifty Bank, the good news this morning is it's made yet another higher high. Over the last few days, the trend was it was making lower highs, lower lows. So the hope is that that one could lead it for the bulls from here on.
All right. The market open is good, right? 40 points is bad for cables and wires, but otherwise it's a decent kind of start. I'll just mention a few names very quickly. Bandhan is the biggest volume-led gainer. It's up 7.5%. It's followed by Chola, which is up about 4%. IndusInd is up next 2%. Shriram Finance is up 3.5%. So the top four volume-led gainers are all from the banking financial services space. And actually throw in a RBL, which is up 5%, 167 on RBL. Look at Credit Access, 7% gains on Credit Access, 922 in the MFI space. We'll have the Muthoot management join us in a bit. Stock's up 2.5%. Stock it's back above 2,200. The management of Sirma was with us in the morning at 8:30. Sirma is starting 8% in the green, so 456 on Sirma. So the stock taking, the market taking note of some of the commentary, I guess. I don't think there's any fresh news flow it's reacting to, except that IDFC First is up 2.25%. There is Inox India, which is up 6%, all with decent volumes here. So 962 on Inox India. There is AB Capital, which is up about 3%. AG's Logistics is up about 3%, and so it goes. But this is, the bulk of the big volume-led gains that we have on our screens at this point in time. And of course, I think, on the downside, by the way, the market breadth is flipped. It's 1,300 stocks down and about 850 stocks which are higher right now. The overall NSE market breadth, and of course, cables and wires taking a hard knock this morning. We have Manishi Ray Chaudhary with us, Chief Executive Officer at Demur Capital Partners. Manishi, good morning. Good to have you with us here. So if an institutional client calls you this morning, Manishi, for a view on cables and wires and says, well, guess what? You've got UltraTech entering the space, and I own Polycab, and I own Havells, and I own KEI. What would you tell them?
I will tell him two things. Number one, as Finance 101 tells us, unrelated diversification, non-core diversification is always bad news. And if the promoters of the company decide to set up a new company entering this business with their own money, that's fine.
Manishi, from the point of view of cable and wire companies, UltraTech we'll talk later.
Right.
But for the incumbent players in the space, sorry, go on.
Right. That's the second bit. And secondly, when company or a group which is cash rich and has the proven ability to raise cash in the capital markets, when they enter a new segment, that's always bad news for the incumbent players. This particular segment is, it had been for the past several years a benign oligopoly. So when you have a large group entering this sector, it creates a degree of, it obviously creates a degree of uncertainty, and that is what we are seeing now here. Many of these companies that have today declined about 9 to 10%, they were also trading at rich valuations. So a very small piece of bad news is enough to prick that bubble.
So better to get out on day one of the fall, Manishi, if one is an investor in cables and wires?
It would obviously depend on the kind of position that one has. Over the longer term, over the next maybe 3 to 5 years, this sector is definitely attractive. But what investors should do now is to very carefully assess the kind of valuations that they're paying for, get out of the relatively expensive stocks, may stay invested in the relatively cheaper ones, and also the kind of niche market leaders. We're actually seeing this not just in this sector, but in all across India. It's the market leaders who are able to command pricing. It's the market leaders who are able to gain market shares. So I think for the foreseeable time horizon, that would be the strategy to play.
So Manishi, now back to the broader markets. We've had a very nasty knock. We knew it was coming, given the kind of one-way rally, the valuations. It's just that when it comes, you feel so unprepared, and there is pain. Do you think there is more pain that lies ahead of the Indian markets, or are we closer to the bottom for the large caps and the mid cap and small caps?
Honestly, it does not surprise me. I have been saying this since late last year, and on your channels also, that India is overvalued. And at that time, in late September, early October, Indian valuation premium compared to Asia ex Japan was about 90%. Now that has declined. Nifty 50 or BSE Sensex, the frontline indices, their valuations have declined. 1 year forward P declined from 24 to 25 to about 20 right now, which is closer to the long-term average. Having said this, I must still point out that earnings estimates are still declining. Over the past 6 months, I think both small caps, mid caps, and the frontline indices, EPS estimates, consensus EPS estimates have declined about 10 to 12%. I personally think that in certain sectors, it's likely to continue for some more time. There are some sectors, let's say IT services or some of the other exporters, where I think the currency has been a tailwind. So there has been a bottoming out of those earnings estimates. But it's difficult to take a call on the market bottom right now. I would possibly be in a wait and watch mode. There are two variables I would look at. Number one, I talked about the earnings estimates on an overall basis bottoming out and beginning to recover. And second, the currency. We are seeing some good signs there also. The dollar seems to be moderating, but I would possibly, be in a wait and watch mode for these two variables right now.
Okay, all right. Hi, Manishi. Good morning and good to see you in. Manishi, but, India has gone through a period of underperformance, right? I mean, if you compare MSCI India with China, with, the developed markets as well, do you think that from here on, give and take everything, the valuations, the economic activity on ground, the accommodative stance from the RBI, the kind of measures we've heard from them in the last 50 days or so with regard to the rate cuts, OMOs, Forex swap, and now, they've been mostly accommodative. Do you think India has a good chance to outperform from here on?
I think there are a couple of variables, domestic variables, that have changed for the better. First, as you rightly pointed out, the RBI's relatively more accommodative stance compared to even about a month or two ago. Second, this injection of money into the hands of consumers, which we saw in the budget, 1 trillion rupees of tax breaks. It would obviously take time for the beneficiaries to spend more. And for that, maybe another quarter to get that reflected into corporate top lines and earnings. But at least these are, variables that have turned for the better. But remember that at the same time, there are some other variables that have turned for the better in some of the larger markets in Asia. For China, DeepSeek changed everything. It focused attention on the Chinese tech companies and their ability to reduce the tech usage costs across the world. At the same time, China also expanded their consumption support program in January. Their own version of Cash for Clunkers program was expanded significantly to include smartphones, wearables, etc. So it seems that China is now increasingly focusing on consumption support, and that would get reflected in the meetings that are coming up. As you might be knowing, between March 5th and 6th, they have the 2 sessions meetings, which are possibly the most important trigger to look at, as far as the Chinese markets are concerned. So, while domestic variables have changed for the better in India, some of the other options in the Asia ex-Japan markets are also increasingly looking more attractive to the foreign investors. And I think, we have to balance both sides. So it's for the next 1 quarter or so, I would possibly be in a kind of a wait and watch mode on India, as I, kind of said just now.
All right, Manishi, we will, no, absolutely. Wait and watch seems to be broadly the theme out there. Let me just quickly take a look at, if things have changed around at all for these cables and wire companies. Nothing at all. KEI is down 10, Polycab is down 10, Havells is down 8, RR Kabil is down 11. So these are steep, sharp knocks which are coming through at this stage. And UltraTech is down 4. So UltraTech started down, with a 1% cut tentative, but is down a full 4%, and is the #1 volume-led loser at this stage. So that's what's coming through. I mean, the mood in any case is not all that great. And on top of that, negative news flow. I mean, you basically get hit twice with twice the impact than in sort of up markets. Manishi, thank you very much for joining us. Great speaking with you. Appreciate it very much. Nigel.
Well, let's focus on the big story. UltraTech Cement. They are focused on entering the cables and wire segment with a capex of around 1,800 crores. To understand the impact on the company, that's UltraTech, we have Mangesh Badang, who joins us to help us out with what would his preference be from cement and what they should have ideally done. And the stock that's under pressure, KEI Industries. Mr. Anil Gupta, the Chairman and Managing Director, joins us on the show. Good morning, gentlemen. Thanks a lot for joining in. Well, Mr. Gupta, I'll come across to you first. Another big name coming into your space. You have close to around 10% of the market share. Do you think the industry is big enough to accommodate a large name like UltraTech Cement? Do you think that, in fact, you're going to be under pressure from here on because that's what the stock market believes?
Nigel, I'm absolutely clear that this and the market space is big enough to give space to another player. Number one. Number two, UltraTech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take minimum another 3 to 4 years to or 5 years to develop the brand for wires, and also to get the, if they come at all in the cables, it will take many years to get the approvals from different customers, different utilities, different departments, and also develop their channels. Secondly, this space is having thousands of customers. It is not like cement that you sell to some distributors and then they further distribute. Here, lot of businesses we are doing B2B, where we are having direct relationship with the customers, and our SQs are too many. Our number of items we deal with, the number of type of cables we deal with is too many. I mean, no company can do it unless they are focused on an industry for at least 15 to 20 years. So I have no reason. We are export focused. We have a lot of marketing team in place. So I don't have any fear about it.
Okay, all right. Mr. Gupta, you're putting down some points, and you believe for the next few years, at least, UltraTech will only be able to make a material impacts in the next 3 to around 4 years, according to you, and you believe the industry is large enough to accommodate another large player as well. My question to you is, going by what happened in the paints division, and their foray out there clearly disrupted the space, and margins came under pressure as well. Do you think it'll put a risk to margins of cables and wires companies like you?
Absolutely not. We are already working on very thin margins of anywhere between 10.5% to 11%. And I mean, a newcomer, their costs will be much bigger. I don't think that, and they will take time to scale up the production. So I don't think that it will bring any pressure on the margins. Also, they are a listed company. They also have to make money. So they may not be able to disrupt the market by just slashing the prices, because it is in this space it is very difficult to increase the prices once you slash them.
Just one more point, sir. The unorganized market is around 25 to 30%. So do you think all of you all will prosper and you all will take away market share from the unorganized market? Is that the way you see things, from 25-30%, the unorganized market, say, goes down to mid-teens? Is that the way you're working with?
Unorganized market will always work differently. Means, till even now we have no competition with them. They have a separate segment of, markets where they work. But our markets are always organized, and we have to compete with the organized players.
What is the difference, Mr. Gupta? Hi, good morning, Prashant here. That question is in the context of basically whether UltraTech, a new player, will go after your and other organized players' share, or will they kind of organize the unorganized? So what is the difference? As you say, you compete with organized players and not really unorganized, and that's a separate segment.
Yeah.
No, what's the basic difference in your industry between, as you said, you compete with the organized space and the unorganized will remain, is a separate segment. What's the basic difference here?
See, it's not the unorganized means the companies, who may be working with bill or without bill. I don't know. I'm not commenting on that. But I don't know what is the definition of unorganized. Unorganized may be very small players in the market, and whom you call unorganized. I can only say that we are going to continue to compete in the organized market, and the markets is growing rapidly, and not only in India but also geographically. We have a lot of footprints in India as well as outside, and I don't see any impact on our business for next 10 years and our growth also with UltraTech coming to this business.
Will you have to spend more on distribution? Will you have to just give us a size? What is the size of the industry? What is it growing at? And what's the growth rate you see for the next few years? And will you have to will you quicken the pace of how well you distribute it across the country? Is there a geographical aspect to it? Just some of those things, sir.
See, we are already present all over the country, and so far as distribution is concerned, we have our distribution channels in every part of the country now, and our models will continue to take our distributors along with, so that we continue to get the market entry into new spaces. Market is growing rapidly in terms of industries, real estate, where the wires goes. So far as cables are concerned, they goes into the infrastructure, new industries, and power energy sector, and as well as exports. So, I mean, the market, I think, will be growing anywhere between 13 to 15% year after year, and no one player can garner this kind of market. It is not copper or it is not cement that one or two players can monopolize.
Okay. Since you mentioned copper, Mr. Gupta, I wanted to understand, do you think UltraTech will have some kind of benefit because their group company Hindalco is into aluminium as well as copper, or you believe that raw material availability is not a big benefit to them? Your analysis?
Yes, it will not be a big benefit to them. Reason is, no company would like to subsidize one business to the another. So and even if one subsidized by 1%, how does it matter? Import channels are also open. So I have seen that in this context, we can continue to depend on imports. There are other players in the copper coming up, like Kutch Power of Adani, and Vedanta is already there, and imports are already easily available. I don't think that there will be any problem so far as supply chain of copper is concerned.
Mr. Gupta, just a couple of questions. Just to reiterate, you don't expect margins to come under pressure. It should stay at 10 to 10.5%, right?
Yes, absolutely.
But you have plans to expand your margins by 150 basis points by FY28. You've guided for that in the past. So what happens to this margin expansion target?
There will be no problem in margin expansions, because this comes by economies of scale. And I have said that we have no fear in our growth plan of 20% plus for next 5 years, doubling our turnover to 25,000 crore. And we are rapidly growing in the export markets. I see that in next 2 years, 20% of our sales will be coming from export markets. We are already well established. We have a lot of approvals in many developed countries. So I can assure that there is no reason to worry.
So no risk to 150 basis points margin expansion by FY28. You maintain your revenue target of 25,000 crore by FY30, which means a 20% plus kind of revenue CAGR from here, and exports should hit 20%. Is that correct, Mr.
Yes,
Gupta?
absolutely.
And you also have a capex plan. I think you've already acquired 60 acres of land. Do you get the sense that, with UltraTech also coming on board, many companies are planning their capex, there could be a bit of an oversupply situation? Or would you rethink your capex?
No, there is no question of any rethinking of capex. In this year, we are doing a capex of close to 800 crore, or next year the capex will be 1,000 crore, which is ongoing at our new plant coming up at Sanand. And in the next financial year also, we will be doing a capex of close to 800 crore. We will not be reviewing or reducing our capex plan, and our growth trajectory will remain the same.
Okay, all right. Thanks a lot, Mr. Gupta, for joining in. You're trying to allay concerns of investors. For the time being, they're very, very nervous. But as you're saying, no change in your growth plans, no change in profitability. Industry is big enough to accommodate another big player. Thanks a lot for joining in. Well, let's hop across to Mangesh. Hi, Mangesh. Good morning. Thanks a lot for waiting by. Mangesh, why did they do this, right? I mean, UltraTech, the purest play on cement, the king of the ring, they have been maintaining their profitability. Why would they do something like this? Your first take on it.
Yeah, good morning, Nigel, and thanks for having me. Yes, the same question. So basically, what we have seen is that historically, the Aditya Birla Group has tried to, create certain pure plays who have growth bigger in the segments that they operate in. And most of the conglomerate business was in Grasim, which is basically the holding company of the group. Even the paints foray that they announced was announced through Grasim, and this is a relatively smaller investment compared to the paints business what they have invested. So we are also surprised that why they choose UltraTech as a vehicle to invest in, and whether the next stage of investment. So they basically mentioned that they want to be part of the entire construction value chain. So the jitteriness would be on whether next set of investment would also be routed through UltraTech, whether it will have an impact on capital allocation through cement. So that's the big question, and it's in that sense, it is quite interesting to see whether where this corporate structure goes from here on.
So you're saying there's a risk that there could be further capital allocation in this non-cement play, and that could be a risk, right?
Yes.
Okay. The stock is down now 4%. If I put in the numbers, this is less than 10% of their annual capex, this 1,800 crores approximately. Their cash flows are superb, 10,000 crores per annum. In that scheme of things, the stock is down 4-5%. Do you think part of the bad news is in the price? And if there is no additional capex in non-cement businesses, do you think then the stock looks pretty well placed? Because after all, it's corrected from more than 12,000 rupees plus to these levels.
Yeah, see, the current correction is not because of any cut in numbers, because anyways, the foray that UltraTech has announced, that will probably get completed by end of FY27. And as my former speaker said, that probably it's going to take 3 years. So basically 2 to 3 years, I don't see financials getting impacted much. But as I said, it's largely based on sentiment. So we need some more clarity in terms of where the next set of investment is going to come from. And whether now UltraTech is, because probably the operating cash flow of the business is relatively better, whether this will be used as a vehicle to finance most of the new ventures of the group. So that's where the uncertainty lies. So if there is more to come from here on, definitely I don't see this as a buying opportunity. But if I have to look at it purely as a cement play, definitely I would buy it.
Okay, and in your cement picks, where does UltraTech come in there? What is the top buy?
Yeah, those are large cap names that we like. We like both UltraTech as well as Ambuja. And the third one we would like to pick currently based on the regional dynamics is Shree Cement, which we feel is interesting.
Okay. All right. Thanks a lot, Mangesh, for joining in. That's the only question I've heard from all sell-side analysts. Why? Just why would you do something like this through UltraTech Cement? For the time being, the stock is down close to around 4%. We'll have to wait by to see whether or not they have bigger plans with regard to putting money in non-cement businesses. For the time being, UltraTech is down, but the bigger pain is in the cables and wires businesses. Let's slip into a short break. On the other side, we'll get chatting with George Alexander Muthoot of Muthoot Finance. We'll be joining in to tell us about RBI's approval to open 115 new branches. Stay with us for that conversation.
Welcome back. The mid-cap index is down nearly 0.5%. And outside of the cable and wire stocks, Inox Wind has a cut of 7%. Vijaya Diagnostic, it rallied hard on Tuesday towards the end of trade, and now it's giving up some of its gains. IEX has taken a knock. Ola Electric is under pressure, and Ola Electric is now 63% off from its 52-week high. And railway stocks like RVNL, Ircon too are weak in trade. Cuts there of about 2.5%. But what's holding up in the green and going strong are the banks, NBFCs, MFIs. So Abhishek is here with more.
Rima, RBI has reduced risk-weight asset requirement for bank loans to NBFCs, and this is with respect to the momentum that you are seeing with the growth rate that has actually tapered down. So when the growth rate was about 30% YOY with respect to bank loan to NBFCs last year in October-November period, at that time RBI had put brakes and RBI had increased the risk-weight asset at various categories. Now that growth rate has declined to 7% YOY as of December sectoral data that RBI gives out, and that has put the comfort lid with respect to pulling down the risk-weight asset requirement that RBI had placed when the going was very aggressive. So restored risk-weight asset requirement with respect to bank loans to MFI sector by cutting the risk-weight asset requirement by 25%. Bank loans to NBFCs also by 25%. So this augurs well with respect to the funding requirement that NBFCs do get in, as lower risk weight asset would make it attractive for them to go to bank borrowing as well. So some of the analysts have written note on the same. We have from IIFL Securities, which states that about 7 to 170 basis point of CET1 benefit is seen for banks, with a higher benefit for Bandhan Bank. About 170 basis point of CET1 ratio benefit occurs due to this risk weight asset requirement being lowered down. Bank of Baroda, Ujjivan as well as IndusInd Bank. So some of the key movement with respect to stock price that you are seeing is of Bandhan Bank, Credit, RBL Bank, L&T Finance, Chola, Shriram as well as AU Small Finance Bank. Back to you.
All right, Abhishek, thank you very much for that. So that is financials, but let's just stay with financials with specific news flow with regards to Muthoot Finance. We have George Alexander Muthoot, Managing Director at the company, now joining in. RBI has given them approval for opening 115 new branches. Mr. Muthoot, great to have you with us here. Thank you very much for your time. Prashant this side. Good to see you always, sir. You've got approval to open 115 branches. Could you give us a sense of what that means for business momentum at Muthoot?
Thank you, and good morning to you, Prashant. So, occasionally or periodically, RBI gives approval to Muthoot Finance to open branches. Last year also, maybe around this time, or maybe a little more later, earlier last year, we also received permission to open about 115 branches. So 150. So I think when we finish that, we have for the next list of branches. And now it's just a usual routine procedure that they give us permission for these branches. Now, the fact that for gold loan companies, customers are more comfortable to bring their gold or precious ornaments to the nearest branch and give it to them. In fact, 99% of customers prefer to come to the branch banks to deposit their gold. And gold has to be deposited for giving a gold loan. So opening a branch will definitely help us to increase our reach in newer locations and also increase the customer convenience for gold loan sector. Today, gold loans is a flavor of the market. More and more people are using the gold loan finance to get their money or their cash requirements. So opening up these branches or giving permission to start these branches is definitely good for Muthoot also.
In terms of the growth guidance, does that change because of this?
At this point of time, I don't want to change any guidance. We have given some good guidance last time also. So let us wait for a month. But on that question, the business is looking quite good this quarter also. So we are quite happy with the growth which is happening in this month also. So I'm not changing any guidance, but certainly there'll be better performance this quarter also.
Your guidance was for 25% AUM growth. Is that correct?
Yeah, I think 25 to 30 was your guidance, I think. So
25 to
probably we usually give a 15% guidance year on year. We don't have been not changing that. Of course, we have been able to do much better in many years, maybe 20, 25, 28, etc. We've been able to do. And this year looks good, actually.
Okay, so 25 to 30% AUM guidance stays. How has Q4 been for gold loans? Because Q3 was solid. Your AUM growth was about 37%. I know that's boosted by festival demand, but how has Q4 shaped up so far in the first 2 months, sir?
As I said earlier, Q4 is also looking good. We see good demand, especially in newer areas, and more and more customers are, as I said, utilizing this facility to get their funding requirement. As I said earlier, today, with all this noise in the unsecured loan space, etc., many banks and NBFCs have gone slow in the funding for unsecured loans. So there is definitely a need for funds, and people are using the gold loan as a easy method, easy way to get finance. And finally, money needs to go into the hands of people. The purchasing power of people definitely needs to improve, and I think this is helping. And together with the RBI's note about the risk weight of loans to NBFCs, I think all this augurs well for NBFCs, and certainly augurs well for Muthoot also, because the availability of credit from banks will certainly be higher. The allocation by banks to NBFCs would be higher. Of course, about the interest rate reduction, maybe it may take one quarter or more to see some reduction in the interest of loan from banks.
So for your Belstar MFI, you're saying Q4 things may not change, but Q1 FY26 onwards, we could see a reduction in cost of funds. And how much do you think it could bring it down by?
I'm not very sure. Probably 50, 60 basis points is what we see there. But of course, one important thing there is that microfinance in the last quarter, this quarter, etc., nobody is growing. Everybody is just consolidating their books. So the need for funding also is much lesser. Having said that, probably the reduction of cost reduction will certainly be there in the next few months.
Okay, so that 50, 60 basis points is cost of funds for you, is it? Eventually,
yes,
it
exactly,
could be that much.
Exactly. Cost of funds, yeah. Cost of incremental borrowings.
Okay. For gold loans, Mr. Muthoot, what is your incremental loan to value ratio, sir?
The loan to value today, actually, if you look at the total portfolio today and today's gold price, our loan to value is only about 63%. But we give up to 75%. People take 60, 65, 70, and quite a few people take 75% also. So whatever is the requirement is what we give. Today, because the gold price is also high, if you see the whole book today, the loan to value is only about less than 65%.
Overall, it's less than 65%.
Yes.
A loan to value. But you can go up to 75 is essentially what you're saying. And Mr. Muthoot, just one quick thing. I mean, we've had a dizzying rally in underlying gold prices, right? Very, very sharp move. It's like, in a way, maybe not like any other financial asset, but it's also like any other financial asset. We can see sharp moves either way. If we were to see a sharp pullback, Mr. Muthoot, in underlying gold prices, how would that impact you, a lender?
Yeah, the incremental lending would be based on the current gold price. So today, if the gold price is falling, the new loans loan tenure is only 4 months, 4 months, 5 months. So the new loans will be given at the new LTVs only, the new price. So since we do that, there's certainly a risk mitigation mechanism. And mind you, we go only 75% maximum.
Okay, maximum of 75%. Mr. Muthoot, thank you very much for joining us. Appreciate you sort of being here on the program, and good seeing you as always here on CNBC-TV18. Thank you and good luck. I think we have the management of Titagarh Rail with us, Rima.
Yes, Titagarh Rail Systems is on our radar. In Q3, it was a muted performance for them. They were impacted by order execution delay. But the company has also announced its ventures into two new areas of growth. One of them is shipbuilding. They're present in it right now, but they want to expand it. And the second one is setting up safety and signaling systems. Umesh Chaudhary, Vice Chairman and Managing Director at Titagarh Rail Systems, is now with us on the show. Umesh, morning. Thank you for joining in. This is Rima here. So first, let's talk about these, two new growth areas. One is shipbuilding and maritime, where you're already present, but you want to expand it. So what's the current size and how much do you want to scale it up to, and what are the steps that you're taking? And secondly, in the safety and signaling systems, lay out your growth plans.
Sure. Good morning, Rima. So as far as the shipbuilding and maritime systems is concerned, we have done a number of vessels for the Indian Navy. We have done some vessels for the Indian Coast Guard with GRSE. We have also exported a vessel. We have done ocean research vessels, but they were all done in our yard in Titagarh, which has physical capacity constraints. There's the water draft and the air draft capacity constraint. So considering the policy initiatives of the government of India, which in the budget we heard about shipbuilding and maritime systems by the Honorable Finance Minister being said a number of times, the board decided that since we already have the pre-qualifications, we already have the necessary soft skills, etc., we should look at this as a growth area. When we took up the passenger rail system business expansion a couple of years ago, I had also on your channel said that we would not be making any capital allocation for next 1.5 to 2 years in the shipbuilding. But now that we have almost come to a completion of the passenger rail system investments, we thought that this can be the next engine for growth for the company. And that's how this is being set up. The plan is to set up another yard, maybe both in the eastern side and the western side. And we will come back with the announcements as the story develops.
What's the size of your shipbuilding and maritime business? Sorry, let's just finish
Sorry. So on the shipbuilding and maritime systems, we have an order book just about 300 crores. We are building about 10, 11 vessels for the Indian Navy as we speak, but these are smaller ones. And with this planned expansion, we would like to take up even the larger vessels. So as far as the scope, the growth potential of this is concerned, it is phenomenal because a very small percentage of the ships that actually, even for inland water or for specialized vessels that are operating today in India, a very small percentage is actually produced in India. And that's what the government is kind of emphasized. And we believe that the possibilities that exist in this sector are quite enormous. And having all the necessary skills, we believe we'll be able to make a very quick entry into this.
What's the capex you've earmarked?
We will announce that. We are still working on it. We've appointed the CEO. We've appointed the team. We are looking at the new yards, exploring at the different parts of the country where we would set up the new yards. So in due course, we would definitely, once the business plan is finalized, once the capex is approved by the board, we'll announce that.
And how soon, to your mind, once you complete all the setting up, the commissioning, how soon can it start generating revenues?
So the revenue will start generating immediately, but the ramp up will happen in a couple of years. So the revenue we are already generating because we have this is not a completely brand new business that we are starting. But those revenues are insignificant, I would say. So the meaningful revenue, I would say, would start getting generated from 2 to 3 years. But what is going to be important in the next 6 months is finalization of the infrastructure plans. And from the next 6 months to the next, say, 1.5 years from thereafter would be the order book that we can build up. So that's how the progression of this business in terms of the KPIs would look like.
Okay, but that's the next engine of growth, as you called it. And for safety and signaling, this is a new business vertical for you.
So again, we are already the leaders in the freight segment. We are establishing ourselves on the passenger segment. And if we really look at the railways complete ecosystem, you see, when we changed our whole focus from just being a wagon manufacturer to a rail systems provider, we had this in our mind that we should be end to end in terms of not the construction activity, but in terms of the system. So after the freight and the passenger, we believe that the kind of requirements that are there, both in terms of technology and in terms of quantity for the safety and signaling systems, it made immense sense for the company like us to be in that. We already have an MOU or a joint venture rather with a leader in this segment in called Mermek, which was not very active. It was dormant over the last year or couple of years. So we have initiated that, and we've already started participating in the tender. So we believe that the kind of budget, even if you look at the budget allocation that happens from the railways, a substantial part is happening and will continue to happen on safety and signaling. So we believe that it is a segment that we should not give a miss to.
Okay. And just one final question then. Q3 was a bit muted. There were delays in execution. Has there been a pickup in execution in Q4? And what are you likely to end the year with?
So, in terms of the delays of execution and Q3, it's not relating to us because our capacities are already at 1,000 wagons a month and we are fully on track to deliver 1,000 wagons a month. The problem happens because the railways were not able to give us the wheel sets, and this has been a perennial problem that has been existing for, I would say, decades. Ever since I came into this business, we've been having sporadic problems on wheels, and the Railway Ministry and the Government of India really took a definitive step for the first time in independent India, wherein they awarded a contract to set up a new wheel plant, which is being done by us and Ramakrishna Forging in joint venture. So, of course, that will take its time to come in. It will take by 2026, it will start production. But for the time being, railways have been ramping up the production in their own rail wheel factory. It's not yet completely streamlined, or it's not become normal. We expect that in the next month, maybe March or April, wheel supplies from the railways will start getting normalized. But till then, we are continuing to have problems on availability of wheel sets.
Thank you, Umesh, for joining in. Look forward to the next one. We will slip into a very short break. We'll come back and talk commodities on the other side. Stay tuned. Welcome back. Let's talk commodities now, and Manisha is now joining in. Manisha.
Well, thank you so much for that. I'm taking a look at the crude oil prices right now because yesterday we saw 2% of a decline coming in for prices, and with that it's trading at a 2-month lows right now. Well, that is the report card on what the crude oil prices have done in last months or years. So in 1 week itself, we've seen prices decline by 5%. It's down 7% in last 1 month. And in this year until now, the crude oil prices have declined by 4%. If you look at the year-on-year prices, we're down by 12% in case of crude oil prices. Also remember 2023 and 24 as well. Crude did post both of these years into negative, and 25 hasn't started on a better note as well. As you can see, we are down 4% already in this year. But there are contradicting fundamentals on crude. When you talk about the factors which are weighing onto the prices, the major clearly comes in from potential Russia-Ukraine peace deal. If that happens, that would mean that you will have Russian oil coming into the markets as well. That would increase supplies, and that could weigh onto the prices. The other point is about the tariffs on in case of crude when it comes to Mexico and China, even Canada for that matter. And that could really disrupt the markets, not see economic growth come in, and that's weighing onto the space as well. But I also want to take you through factors which seem to be supporting crude oil prices at this point in time. The major in this is the crude inventories itself. If you look at the last 7 weeks, we've seen the US crude inventories continue to decline. The latest decline has been by 2.3 million barrels, and that is supporting crude prices. And then you have to look at the US crude production itself, which is at record highs at around 13.1 million barrels. This is a major news that came in overnight, where US is talking about revoking Chevron's license to operate in Venezuela. But at this point in time, Chevron really is 25% of Venezuelan exports. And if you look at that overall number, that stands at 240,000 barrels per day. If that goes out of the market, then you are looking at support coming in for prices. Apart from that, it also has to do with US buying crude for its strategic petroleum reserve. Remember, US has been saying that every time the crude prices come down, US would want to buy for SPRs. And now that the crude prices are trading at a $68 a barrel, you could be looking at that buying coming in from US as well. But there are some factors which also are leading to a lot of uncertainty into the markets, with the US especially reaffirming plans to impose tariffs on energy imports from Mexico and Canada. It has talked about 10% on Canada and 25% on Mexico, but we still have to see that final paper there. And then US also is threatening tariffs on European Union goods. So that uncertainty continues to keep the markets very, very volatile and jittery as well. If you look at the Goldman Sachs report, which came in overnight, it says that the Brent prices will trade between 75 to 80, exactly where we are trading right now. So it's going to be a range-bound trend for the crude oil prices, but volatility perhaps would just about continue.
Thank you, Manisha. For that, we will slip into a break with the news that the Nifty Bank is the only sector which is currently in the green. All other sectors are in the red. And if it wasn't for the 200 to 300 nearly point contribution from the Nifty Bank, we would have been firmly in the red. The mid-cap index is now down 3/4 of a percentage point. Small-cap index is down 1%. And the advanced decline ratio now stands at 1:4. Get into a break. On the other side is our special segment, Indianomics. Lata will be in conversation with a host of guests to discuss the NBFC and MFI risk weight cut and the prepayment penalty waiver.
Hello and welcome to Indianomics. On Tuesday, the Reserve Bank reduced the amount of capital that banks need to set aside to give loans to NBFCs and microfinance companies. Immediately, the cost of funds for NBFCs and MFIs falls, but the bigger message from the loosening of rules is that RBI seems to be determined to do everything to spur growth. Look at the sequence of events in the past quarter. First, on December 9th came the CRR cut, which brought in 1.13 lakh crore immediately into the system. Second, since Jan 1st, the Reserve Bank has infused 1.38 lakh crore by buying bonds through the open market operations, OMOs as we call it. Third, it started daily repo operations since January 15th to give banks temporary liquidity comfort. Fourth, it has done $5 billion of FX swaps in January and is doing another $10 billion swap on February 28. Together, they will infuse 1.3 lakh crore into the system. That's a liquidity increase. That's on the liquidity increase. On policy, we got the first rate cut, the first in 5 years, on February 7th, and finally, earlier this week, as I just said, lowering the curbs on loans to NBFCs. Now, separately, the Reserve Bank has also reduced prepayment penalties, and that can spur in its own way MSME borrowing. So now the big question, is all this enough to spur bank lending? More importantly, is it enough to spur growth, and will economists now increase their GDP growth forecasts for FY26? What more can RBI do? I have with me an elite panel, Mr. S.S. Mundra, former Reserve Bank of India Deputy Governor and former Chairman of BOB, now Chairman of Samman Capital, of course, Chairman of BSE as well. Suresh Ganapathy, the finance company's expert from Macquarie Capital, and Nikhil Gupta, the economist from Motilal Oswal. Gentlemen, thank you very much indeed for your time. Mr. Mundra, to you first, sir. A huge set of policy announcements, but most important is the last one, that the NBFC loans will now cost less. Do you have a confidence that Reserve Bank is going all out to improve credit growth, or should we look at it as a very incremental step? You know, if you can wear your DG hat, the NBFC's loan to NBFCs was growing at 30% in 2023. Now it has come down to 7%. We are happy, we have changed. This has got nothing to do with overall policy reset. How should we look at it?
Okay. First of all, Lata, I would look at it like this. Probably to my mind, at least I don't recall a series of events. It will be one of its points that the risk weights have been increased and then they brought down within such a short, window frame of the time. Normally, this kind of action is taken. It remains for quite some time, and before the things settle down. So, at least you may correct me, but I don't recall. So it means quite clearly the data points which are available to RBI and also the data points which are publicly available, there had been a sharp deceleration. RBI is surely, I think, looking to boost the growth. Okay. I look at it like probably the first action was kind of a message to the lending community. Lending community has responded to that message, as we can see from the data point. And now that action is reversed. So probably with the expectation that a message has been conveyed, and now this message would be kept in mind in the future behavior of the lender. So now it is for the lending community to stick to the discipline which has been brought by this. Mm-hmm. But coming back to the point, now with this kind of change in risk weight, I think around 40,000 crore of capital would be released, which can translate into 4 lakh crore of incremental lending. And now if you look at the other measures of providing the liquidity, because, okay, if you have the capital, but if you don't have the liquidity, then the end result would not be the same. So it's a combination that the capital is made available, liquidity is made available. Key question would be, to my mind, whether this incremental lending would go to the productive sector or it will go to boost the consumption. Okay. Nothing wrong in either way, but again, I think the lending going to productive sector is a more welcome situation. But then depends on what kind of demand is coming, what kind of confidence level that sector is looking at it.
Okay.
Consumption growth is fine, only the precaution, it should not again, result into making the people over-indebted, which has its own set of problem. And then there could be, in the federal system, there could be actions by other players, which we have already seen.
That's
so
true,
I
sir.
stop it here, but this is how I look at this big
No,
picture.
fair point, sir. Actually, to be fair, the Reserve Bank has not reduced the risk weight on unsecured loans. They're very correctly giving a message that NBFC loans need not suffer anymore because NBFC sources of funds appear to have gotten more balanced. It was too dependent on banks. Now they have kind of corrected it and depending more on market. It seems to be the spur to consumption, at least I can't see it. They've still kept the cork on unsecured loans. But Suresh, for a more immediate, reaction, do you think we can see NBFCs as the biggest beneficiaries? Their margins improve and their loan growth improves. Can we come to that conclusion?
Yeah, look, all these things will take time, Lata, to play out, right? It's not going to be quite immediate because of the fact that the liquidity in the current markets are still pretty tight. So nothing is going to happen before the end of this financial year. And then, of course, you start off on a weaker footing on April to June because seasonally it's a pretty weak quarter. So all these things will take time. A point which I would like to just drive across on this 40,000 crores and 4 lakh crore number. Look, I mean, this is all notional calculation, right? See, at the end of the day, you have to understand that the system common equity tier 1 was already running at 13.5%. This only adds an additional 20 basis points, theoretically, right? You can anyways go down to 12-11% and could have lent that money. The bigger problem is that of demand and not of supply, to be very honest. At this point in time, the RBI is doing whatever it could do from the supply side angle. We really need to see demand picking up. And for that, we have to see what could be the implications of the tax cuts and how exactly the overall market responds to that. So of course, at the margin, the NBFCs get the relief, but I would not really immediately pencil in growth numbers coming into the financial statements for either banks or NBFCs in the immediate future.
Okay, well, actually, as we speak, Shriram Finance up 4.4%, Bajaj Finance at a 52-week high, 2.2%. Of course, it didn't go up either, so that's why the correction also is only 2.2%. But do you at the moment are not changing any of your EPS numbers for FY26 for any of these companies?
None, because Lata, look, the multiples have already gone up, right? I mean, the initial reaction to any such move usually tends to be re-rating. And then the earnings are expected to come with a lag. Right now, even despite all these measures which have been enacted, the growth outlook is still a little bit more patchy, right? I mean, if you look at it, I'm not an economist, of course, you can speak to the economist who's going to speak on this matter, but the overall GDP projections are expected to remain broadly flat. 6.3 may go to 6.5, 6.6%. So unless and until we see a very clear visibility of growth coming back, we don't want to press the gun and go ahead and update.
EPS button. Okay. Well, Nikhil, so the question squarely falls to you. Mr. Mundra very clearly pointed out that he has never seen such a quick policy reset. That I think that nobody pointed that out so far. November 23rd, 2023, you increase risk weights, reduce it in what 13, 14 months. We've not heard of this. So should we look at it as RBI in a hurry to ensure that growth comes back?
Thank you, Lata. That is not for me to say whether the RBI is in a hurry. I hope...
Is that the opinion? Is that the impression that the investors should take home?
No, I think every investor has their own opinions. I am not thinking too much on whether the RBI has done it in a hurry. What I am concerned about is what the RBI has done and what could be the macroeconomic implications of that. Yes, Mr. Mundra pointed out that we have not seen RBI reversing such kind of policy so quickly ever in the past, in the memorable past at least. But just because it hasn't happened doesn't mean that there is something wrong that it has happened now. And I don't know on that. I have no view on whether it has happened so quickly or not. As I said, I hope the RBI has done its homework, and that's why they have made this decision. So, yeah, I mean...
No, my question to you is that do you see all this as a concerted policy push towards growth? And therefore, are you changing your opinion, if not your actual number, on growth, say, 3 quarters down the line?
All right. So, no, I'm not changing my growth projections as of now. I would also want to point out that, yes, if you look at all you mentioned at the beginning of this show, various steps that the RBI has taken, but we also need to understand that what happened recently is a part of the entire sequence. And you rightly pointed out that they have not touched the risk weightage on unsecured loans. Right. So this is a very targeted measure. They want to provide probably some relief to NBFCs and MFIs, which are too dependent on bank, and especially for non-PSL borrowings. It is PSL was never into risk weights were never changed for PSL borrowings. So it's only for non-PSL, and they are still keeping those unsecured risk weightage what they were revised to in November 2023.
That's right.
So it more looks like a targeted measure where they want to probably provide some relief for NBFCs and MFIs, not definitely to boost GDP growth or to boost the consumption-led loans. Overall, it is possible that all these measures may allow some extra room to the NBFCs and MFIs to lend out more. But again, if anything, it would be only incremental, because I don't think NBFCs were too tight on supply front. They did not have money to lend to the borrowers if there was any demand. Because again, when I spoke with our NBFCs analyst, he was very clear that when in November 23, these risk weights were increased, the impact on NBFCs in terms of their cost of borrowings was not very significant. And if that is so, now when those risk weights have been reduced out, the impact would again not be so significant.
Okay.
So I'm not very sure if I would take it as a sign that credit growth is going to be much higher than what we were expecting.
So Suresh is not raising EPS estimates, and Nikhil is not raising growth forecasts for the coming year. But you know, why speak to an analyst, Nikhil? We have here a person who has lent loans as a banker and is still supervising an NBFC, which is lending loans for housing finance companies. So, Mr. Mundra, you know, how will a bank chairman or a bank MD or a NBFC chief look at the sequence of events? Will they press on the accelerator and lend more because they see policy in favor? Or do you think that the reality on the ground, I mean, you would know better, is the reality on the ground not such that loan growth will necessarily increase?
I think the dynamics with the RBI is thinking, if I can say so, about NBFC looks like, you know, sometime coming nearer, then again getting far away. So there had always been concern about the interconnectedness between the bank lending to NBFCs, but at the same time, realization keeps on coming that despite the number of banks increasing, network increasing, the NBFCs continue to remain an important cog in the wheel as far as the last mile lending is concerned. And I think for a variety of reasons, banks had also been finding it a good vehicle for their overall credit growth to keep on accommodating the NBFC, which has quite constrained, as you can see from the recent data point. So while I don't think that suddenly it will create a huge kind of enthusiasm that you just open the tap for NBFCs, NBFCs would also not be expecting that. But I believe that from the point where we are at this point of time, probably there would be a more benign attitude in accommodating NBFCs for their credit needs. And NBFCs would have that capacity, while Nikhil has mentioned some point of time, but I think is a diverse field. There are many players, but I think they would, it will enhance their ability to little push up their credit. So on both sides, on the bank's books as well as the NBFC book, I won't say it will be something revolutionary or something that suddenly a great change will come, but there would certainly be an incremental positive move from this. This is what my reading is.
Okay, incremental positive move. You know, ultimately growth comes not because there is demand, but because there is animal spirits. People somehow have the confidence to consume and take a loan, or bankers have the confidence that there is growth and they lend. Is that confidence returning? The RBI has taken another big step, allowing MSMEs a prepayment option without any penalty. That's also a very pro-growth measure, I would think. Those questions to my panel after the break. For Bazaar viewers, it'll be Chartbusters. You can hear the entire show after market hours.